It says that, so that's a consolidation question. You can see it as March, June 2017. It's a balance sheet consolidation. Usually F7 questions are not very difficult. What they give you, that they give you the balance sheet, two balance sheet, usually one parent and one subsidiary. And then there is some acquisition date, some acquisition happened, and there are some adjustments which we need to take care of. And these adjustments usually are the same which we did the short questions. Like you can consider it like one short question, second short question, third short question, and such. And it says that prepare the consolidated statement of financial position for Dargent Company as at 31st March 2006. So we need to prepare a consolidated balance sheet. Let's start reading the question. I'll read it and I will point out which things we need to pay attention. It says on 1st January 2006, Dargent Company acquired 75% of Latry's company's equity shares. So this is important to remember, 1st January 2006. And the financial statements we need to prepare on, let me see, say 31st March 2006. Now you see there is a trick. It's not a full 1 year thing. The retained earnings or the profits of subsidiary, you have to think for only 3 months because you are acquiring the company on 1st January 2006 and the end of year is just after 3 months, 31st March 2006. So always pay attention to the dates. By mean of a share exchange of 2 shares in Dargent for every 3 shares in Latry. So multiplied by 2 divided by 3. So how many total shares? I usually see when I'm reading a question, I'm making a picture in my mind. The shares which you have here, the share capital which you need to see for this companies are equity shares are 20,000 in Latry. So out of 20,000, they are buying 75%, which means 15,000 divided by 3 multiplied by 2. On that date, further consideration was also issued to the shareholders of Latry in the form of $100, 8% loan notes for every 100 shares acquired in Latry. So for every 100 shares, so you acquired 15,000 shares, you would divide 15,000 with 100, multiply it with 100. So you are giving them some, loan notes. You're not giving them cash. You are giving them loan notes, which also has some interest. Great. None of the purchase consideration. The loan notes at 31st March has yet been recorded in Dargent Company. Now that's very important sentence. It says none of the purchase consideration has been recorded. It means that this balance sheet which you see of Dargent, it has its share capital. Okay, you see here the equity share capital of 50,000. It does not include the new shares which they have given. They actually have given 10,000 shares. Like how do I calculate 10,000? I just made a very quick calculation. This is 20,000, and they got 75% of that, which means 15,000 shares they bought. And 15,000 when they purchase share, they are giving 2 by 3. For every 3 shares, they are giving 2. So 2 by 3. So it makes 10,000. So it means that this share capital, it must be increased with 10,000 shares. Okay. I mean, they are issued new shares, but they say that it has not been recorded by Dargent. So this is not recorded. Similarly, the loan notes which they issued are also not recorded. So you need to issue here some loan notes also. Okay. Plus the interest on the, not the outstanding interest. So this also, you should record the interest. So anyways, when you read the question, you need to keep, try to make a picture in your mind. It is not just words. At the date of acquisition, the share price of Dargent and Latry company is 3.2 and 1.8 respectively. So 1.8 with 3.2. So when they issue in Dargent, we multiplied with 3.2. Why are they giving Latry company's share price? We'll see it later. And these are the financial statements. Usually at this stage, you don't need to read all lines. You will be wasting your time. So now I tell you that when you do a balance sheet question, there are very typical, we call them big 6, like you have big 4 audit companies, there are big 6 adjustments, we call them. Like in every balance sheet calculation, whenever you prepare a consolidated statement of financial position, you need to calculate the goodwill first. And to prepare goodwill, you need to calculate the net assets of subsidiary at date of acquisition. So you need to do you need to do one calculation for calculating the net assets of subsidiary on the acquisition date, consideration. The difference of these two will be the goodwill. You need to cover some other things such as unrealized profit, we call it, like on inventories. We need to calculate NCI at the reporting date. So these are very typical fair value adjustments you have to make. These are the typical 6 adjustments which we usually do. Now, by the way, there are 6 adjustments, 7. Probably to you, it will look more because you are doing F7 at this level. Maybe you think that these are a lot, but when you do SBR or DIFR, you usually have 11, 12, or even 13 adjustments. So 7 is not more. But the idea is that you don't need to read all of them. Okay, when you are doing DIFR, this F7 question, you don't need to read all of them. I know the first thing which I need to calculate. What do I need to calculate? I need to calculate goodwill. Okay, and for goodwill, I need to calculate my net assets of subsidiary. And I need to calculate my consideration. So any adjustment which is related with consideration or net asset calculation, I will pay attention. Other adjustments will only clutter my mind. Let's see what adjustments they give. They say at the date of acquisition, the fair values of Latry company's assets were equal to their carrying amounts. However, Latry company operates a mine which requires to be decommissioned in 5 years' time. No provision has been made for the decommissioning cost of Latry. So this is a provision, a liability. They did not include it. Now you have to create a provision, and it is going to decrease the profits. Okay, because it's an expense. You have to create a provision and debit decommissioning expense or credit your provision or whatever. That will be paid 5 years from the date of acquisition, discounted at 8%. So you need to make adjustments. So the profits will go down. The net assets, because it happened at the date of acquisition. So in fair value, when we were doing short questions, we said that fair value revaluation, which means fair value goes up, then goodwill goes down, stuff like that. In this case, the fair value is going down. I mean, you are doing a downward revaluation because when you will record this expense, your net assets will go down. Dargent company's policy is to value the non-controlling interest at fair value at the date of acquisition. Latry's share price at that date can be deemed to be representative of the fair value. So NCI you will measure like this. Okay, so out of 20,000 shares, 15,000 you purchased, and 25%, 5,000 shares are NCI, and you will measure it like 5,000 shares multiplied by 1.80. So this is the Latry company share. This multiplied by 5,000. This would be your NCI. So this is the second adjustment. The third adjustment they're telling us, the inventory of Latry company includes goods bought from Dargent company for $2.1 million. Dargent company applies a consistent markup on cost of 40% when arriving at this. So this is going to give us unrealized profit, and this unrealized profit will decrease, the retained earnings. of the parent, not the subsidiary, because who is selling? Parent is selling. On 28 March 2006, Dargent Company dispatched goods to Lottery Company with a selling price of 700K. These were not received by Lottery until after the end year and have not been included in the above inventory. So 700,000 we have to add it into the inventory because parents sent, subsidiary did not receive, they still are in transit, we need to add that. At 31st March 2006, Dargent Company's records showed a receivable due from Lottery 3 million. So this is intra-group receivable and we need to adjust for that. Then investment in Ameri company. So this is investment. It has got nothing to do with our goodwill calculation, etc. So let's move to the Excel file and let's see how to start this question. Okay, so what we always in such situation, you start with the goodwill. I mean, most of the balance sheet questions, they start with goodwill. In some cases, you first calculate net assets. If the subsidiary net assets are in complex, you calculate net asset working. But in our question, it is pretty simple. So you can call it working one, and your working one is for goodwill. I would call it goodwill. Okay, how do I suggest you people to make format? You should make one column a little bit longer. The second one is even further bigger because here you will show your calculation and here you put the numbers. So we have to first give consideration. Okay, so consideration is share exchange. The first one is share exchange. So how many shares they were purchasing? So you go back and see how many shares were in Lottery Company. So in Lottery Company, if you see, their share capital is 20,000 shares and the parent is buying 75% of that. So I would say 20,000 shares multiplied by 75%, and they are giving their own shares. If you read the question, the third line it says that, or the second line it says share exchange of 2 shares in Dargent for every 3 shares in Lottery. So 20,000 shares, you are buying 75% multiplied by 2 divided by 3, because for every 3 you get, you issue 2. And the cost of one share, the market price of one share was given as 3.2, the share price of the parent, not of the subsidiary, because parent is issuing share. So you will take parent share price. So it makes you 32,000. Then you also made some loan notes. You said that I will give loan notes for, it says that, Lottery Company in the form of $100, 8% loan notes for every 100 shares acquired. Every 100 shares acquired. So actually you acquired how much? You acquired shares 15,000. I mean, you can still do it like 20,000 multiplied by 75%. It makes all the same. For every $100, so you divide it with 100, you multiply it with 100. It's the same thing. So this is the value which you are offering for the loan notes. Divide with 100, multiply with 100. Because for $100 loan note, for 100 shares, you are giving $100 loan notes. It makes you 15,000. And then there is NCI, non-controlling interest at fair value. So non-controlling interest was 20,000 shares times 25%, okay? Because this is the value. I mean, 75% you got, 25% went to the non-controlling interest. And multiplied by the market price of the share. The market price of the share of the subsidiary company, the Lottery Company. Here you should multiply 1.8. You don't multiply with 3.2. Here you should multiply with the subsidiary's share price because he become owner of subsidiary company shares. So you put here like this, and we can say that the total consideration which has been given is 56,000. And by the way, you should remember here one thing, because they told us in question, we read the question, they said that these two things were not included in the balance sheet. So this 32,000 which they are offering shares. So what is the value of their share? If you pay attention, their value of share is 3.20, okay? But the face value of the share was $1. It means that the shares are sold in the market at premium. So some of that amount should go to share capital and some of that amount should go to share premium, because we know that how do we record it? The share capital, you only record the face value. So the number of shares which you are offering are 15,000. So 15,000 multiplied by 1, that goes to share capital, and the remaining thing will go to share premium. 17,000 will be appearing in share premium account. The 32,000 which you are giving, $2.2 per share is premium. 3.21, so you are offering 25, 15, and 17. 15,000 shares into 1, 15,000 shares, 1.2. The remaining it is, how much it is? Yeah, 15, 17, 32. There are 75% shares. Yeah, they're offering 10,000 shares. 15,000 shares they are buying, but they are only giving 2 shares of them. So it is 32,000 because one share was 3.2. One share was 3.2, so 32,000. So 10,000 shares into 3.2, 32. So 10,000 will come here, and 22,000 will go into the share premium. Yeah, 15,000 we are buying, but we are offering our shares only 10,000. So 10,000 multiplied by 1, 10,000 multiplied by 2.2. So this is one adjustment we will need when we will make our balance sheet. Then we need to find out the net assets. We call it, net assets of Lottery Company at acquisition date. This is what we need to find out. And what is inside? It is share capital, and we calculate the retained earnings, etc. So how much is the share capital? Share capital, usually you take it from the balance sheet, and you can see that the Lottery Company balance sheet share capital is 20,000, and we take here 20,000. And we need acquisition date. Acquisition date was 1st January 2006, I think. So what was the retained earning? If you see, it says that retained earnings at 1st April 2005, and for the year ended 31st March 2006, these are the retained earnings, 8,000. You need to calculate retained earnings on 1st January. So you need retained earnings. You need retained earnings on 1st January, okay? 01/01/2006. This is not given to you, and you have to calculate it. See here, how do you calculate? Now that's important part. You need to pay attention, because what they told us that the retained earnings on 1st April 2005 are 19,000. So this one, plus they told us 31st March 2006. We don't need 31st March 2006. We need until 1st January 2006. So this 19,000 plus this is 1 year retained earning. Okay, from this 1 year we have to take out 9 months. Like January, February, March we don't need. We only need until 31st December. So this is per year. This is for the year. We need 9 months out of that. That would be the retained earnings. Let me write down, and then if you do not understand, I will explain. I would say that retained earnings until previous year, which is April 2005, and retained earning from current year until 31st of December. So this is full number, 19,000. And this one is 8,000 for the full year divided by 12 multiplied by 9, because I need it for 9 months. So I calculated this like $6,000. See what I did. When you are doing acquisition, you need to know that your acquisition date is somewhere here. This is 1st January, okay? 1st January 2006. You need retained earning on this date, but you don't have retained earning of this date. They told you that until this 31st of April 2005, you have retained earnings of 19,000. This company had 19,000. But I need retained earnings on this period. But then they tell me that for the full 1 year until here, this is 8,000. 8,000 is given until, if I scroll it down, let me see how does it work. You see this one. They told you that this 19,000 was in until previous year, 1st April 2005. I'm doing it on 1st January 2006. So I need here, 19,000 is here, 1st April 2005. I'm making acquisition on 1st January 2006, which means 9 months after that. So how much are the 9 months retained earning? I need to add this retained earning, 9 months. 19,000 plus these 9 months I need. And these 9 months, how do I calculate? The full year from here until here. The full year was 8,000 profit. So it was 12 months profit. You just divide it with 12 and multiply by 9. When you multiply by 9, you get profit for this period. Okay, this is how I calculate profit for this. So the 19,000 plus this profit, this will be retained earning at the acquisition date, because we need to find out what are the retained earnings on the date of acquisition, which means on 1st January 2006. So this is how you calculate the retained earning at the acquisition date. Now let me
yeah, got it. Thanks.
Yeah, let me erase this thing. So then what we have now, we've got here the share capital. We know how much are the retained earnings total. And then there is one more thing, if you remember. They told us in this adjustment that there was a provision. You need to create a provision for decommissioning, which they did not include. Now that provision, and this happened on the date of acquisition, you remember. At the date when you were seeing the financial statements, you tell them that, see, you have not created provision. So they book this profit, okay? They book this profit, but they never book that expense. So this retained earning which they are showing you, you do not agree with this number, because you say that, see, you're telling me a profit, but you just forgot to include this expense. It's a provision. We need to adjust for that. So you need to make a fair value adjustment. So how do you do that on this adjustment when you need to make? It says that, now let's read it. It says that no provision has been made for these decommissioning costs by literary. The present value discounted at 8% of the decommissioning is estimated at 4 million and will be paid 5 years from the date of acquisition, which means 5 years at the end of the mine's life. So that's 4 million. So what you need to do here, now if you remember the process, that you have some provision and you have to pay some amount here, and the present value of this thing, you bring it down and you create a provision, and the present value is 4 million. Now, if you remember that the present value of provision, it goes to your non-current asset, and at the same time, it goes to as your provision. If you remember that the double entry was debit non-current asset credit provisions. We made that double entry when we were doing IS 37. So you have to charge 4 million to your assets. At the same time, you have to charge 4 million to your liabilities. So this is the treatment. They just did not include it. So I need to add 4 million to the asset side of the balance sheet and 4 million to the liability side of the balance sheet. So net result, it will not make a change. So here it will not reflect the change, but it will reflect the change when we make the balance sheet. The numbers will not change here, because you will say that, fair value of asset, and you would say that present value of provision. So these two things, 4 million you will add and 4 million you will subtract. So numbers will not change here, but of course in the balance sheet, your assets will change and your liabilities will change. So 45,000 you can say that net assets of the companies are 45 million. And this is how you will calculate your goodwill, which will be 56 minus 45, that is 11 million. So 11 million, and actually I should be putting some zeros on the top, and this is how you would perform your calculations for goodwill. So 11 million, we calculate our goodwill. We are done with that. And we know that the share capital 32 million will split between the consideration of 32 million will split between share capital and share premium. Now, very typical calculation of goodwill and usually a long calculation. Then if you come down to your, so we have done this note number 1. If we see note number 2, we also have done that. So note 1, we did it. Note 2 is about the non-controlling interest, we did it. Note 3 is about goods, it's about inventory. So you have to calculate the inventory and you call it the unrealized profit, okay? You need to calculate the unrealized profit, any group sales, any amount of intra-group transactions when you sell goods from parent to subsidiary, subsidiary to parent, and the goods are unsold, you call it unrealized profit. We did it before unrealized profit. We need to calculate how much is unrealized profit. So it says the inventory of literary includes goods bought from Dargent. So the parent is selling, goods value 2.1 million. Dargent applies a markup on cost of 40%. So it is a case of markup. You should always pay attention. Is it margin or is it markup? If it is markup, the rule is you multiply by 40 and divide by 140. Just very simple. To find out 2.1 million, we will multiply. So I'll call it unrealized profit, and we'll do that unrealized profit calculation. We come up here, we say unrealized profits, closing inventory, and it is 2 million multiplied by 40 divided by 140. So your unrealized profit is, it's 2 million or 2.1? I think it's 2.1 million. It's 2.1 million. I'll put it here. 2.1 million. It's 600. This number also we need. Let me put it in yellow. Okay, let me explain a little bit again for unrealized profit if somebody does not remember or if somebody has forgotten. So you've got here parent, okay? And let me call parent as B. Okay, and this is parent and this is subsidiary. The parent sold some goods for $100, which parent cost, the cost of the parent was only 60. So what parent will do, the parent will write down 100 in the sales amount because they have sold, and it will put $60 on the cost of sales amount because the goods are sold, and the parent will recognize a profit of 40. And parent can do that. There is no issue. There is no problem. It should be like this. But when you make your group profit, when you make your group income statement for the group, what will happen that this parent and subsidiary, they are considered under the same roof. So when parents sell goods to subsidiary, this sale, which now subsidiary purchased these goods for 100, okay? The sale cannot be considered as sale because parent in its individual capacity can say that I have sold the goods. Parent is right, he has sold the goods. But for the group, the sale is not sale yet because the goods are still under the same roof. The goods are still within the same house. It is just that from one warehouse, the goods have moved to another warehouse. And we consider that goods are still within the group. Goods may not be with P, but they are still within the group. So this profit, which is there, $40, P has got the right that I made $40 profit. This $40 profit is for P. But group cannot consider this as profit because for the group, the sale has not yet happened. For the group, the sale will only happen when S will sell these goods out of the group. When S will send these goods out of the group, only then we can say that group can consider this $40 profit earned. Before, not. Now what happens? That let's suppose that he sold in goods for 100. S company, the subsidiary company, was able to sell 50% only. 50% goods it sold, and 50% of the goods they remained with S, which means 50% of the goods are still within the group. So it means that this 50% which have gone out, here you can realize the profit, but this profit you cannot realize. So if 50% of the group of the goods are still in the group, within 40, the 50% profit is $20. The $20 profit is called unrealized profit. Unrealized profit. So when you will calculate group profit, you will subtract this PUP, unrealized profit. Group can only consider $20 profit, okay, from this particular transaction. So whatever you will calculate this profit, let's suppose his profit is 500. Let's suppose his profit is 300. So individually they will say 500 and 300, but parent will say 500 plus 300 minus this 20. Parent will make a profit of 780. Parent will not say, I'm sorry, the group will not say profit is 800. Group will say 800 total profit minus the unrealized profit 20. So the concept of unrealized profit is that this is the profit on the goods which have been sold within the group and they are still in the warehouse. Yes, if S sells all of these goods, let's suppose S has sold all of them, then no problem, then full $40 can be recognized. So this is, I just made a quick revision of unrealized profit. And why do we need it? We need to make an adjustment to the group retained earnings, okay? And sometimes also to subsidiary. Why do subsidiary? Because that I will speak later. When parent is selling to subsidiary, that's a different scenario. When subsidiary is selling to parent, that is a different scenario. This concept I explained in those videos of F3, which I uploaded. You can watch that further one time more, but there are two different scenarios, P selling to S or S selling to P. These are two different things. In our question, S is not selling. In our question, P is selling. So we just need to do this much, which I explained to you. Now, so we calculated our, goodwill. We calculated our unrealized profit, and now we need to calculate group retained earning, or you can call it NCI at reporting date. And we will calculate group retained earning at reporting date. These are the two things which we need to calculate. So we need to do two workings. One is called NCI at reporting date, and the other is called group retained earning. Now, if you remember that NCI at reporting date was what? We said that NCI at reporting date is equal to NCI at acquisition plus NCI's share in post-acquisition retained earnings of subsidiary. Subsidiary in our case is called Literary Company. So what is NCI at acquisition? NCI at acquisition we calculated ourselves. It was given in question. It was like this one, 9,000. And then what is the post-acquisition retained earnings? So like when the acquisition happened, so whatever profit is after acquisition from that share. So if you remember, our acquisition happened in 1st January 2006. And financial statements are prepared on 31st March 2006. There is only a 3-month period, January, February, and March. The profit for 2006, if you pay attention, that the profit of the subsidiary for 2006 was only 8,000. So how much period is post-acquisition? Only 3 months, January, February, March. So you can say that from this 8,000, we have to take out 3 months profit, 3 divided by 12, and multiplied by 25%. We can say that this is the profit which belongs to the subsidiary, to the NCI. That should be something like 500, if there is no other adjustment. But I think that there is some adjustment if we, what was the adjustment? Let me pay attention. Yeah, there was some other, let me go back and see. Not this much, not this much. Okay, we forgot to make that adjustment. NCI reporting date. NCI will take profit from the subsidiary company. So we should make first this thing. We should say literary companies adjusted profits. Okay. So we say that as per financial statements, because we said that this profit, which we are considering, you see this profit like this much. This is 2 million profit they are showing, but this 2 million profit is not the accurate profit. We need to calculate the adjusted profit. Adjusted means with some adjustment. If you remember that we said that they will recognize this asset, this asset which we recognized here, fair value of asset 4 million, if you remember. So this was an asset. We have to charge its depreciation, and this is a provision, and we have to add its up, unwind the interest cost. If you remember, how do we do provision? We find out the present value, then we unwind it. Every year's interest we start adding into it. So we need to add that interest. We say that depreciation of mine. So this was an asset. This company, Literary Company, never included this asset, but they should include this asset, 4 million, and it has a life of 5 years. So this is the, and plus what you need to do, 4 million into 5, 4 million to 5, 5 years multiplied by 3 by 12, because you have to take only 3 months depreciation. So 3 months depreciation. So this will, what it will do, it will decrease your profit, because it's a further additional depreciation, which they did not include. Because they did not include asset, they also did not include depreciation. Now they have to include. And similarly, there is some provision on decommissioning. And what we do, we know this thing, we use the word unwinding. We have to do the unwinding of that. You have a $4 million of provision, present value, 8% you will grow, because it is interest rate will go, finance cost 8%, multiplied by 3 divided by 12. So this number you will also put here, and it will give you this much, and this should also be in negative. So then you put it here, and it gives you 1720. So this 1720, this is now your, if I am correct, it should be 1720. This is the adjusted profit of your subsidiary. Now here you will take from here, you will say that NCI share in post-acquisition retained earnings. So 1720 multiplied by 25%. 25% of this profit will go to the subsidiary. And I will say like this. So the NCI at reporting date was 9430. And let me actually put it one step down so that I can write down. I will say NCI at reporting date is this much. So this number we need. So this is your, you can call this as your working one. This is your working one, W1. Let's call it W1 so that we don't get confused. And closing inventory, this PUP is your W2, working 2, NCI is working 3, and adjusted profit is working 4. And last of all, we need to calculate working 5 as group retained earnings. So how much are the retained earnings which belong to the group? So group retained earnings are parents' profit, parents' retained earnings. How much are the parents' retained earnings given in the question? Usually they tell you in the question that parents' retained earnings are how much. So you pick up the parent retained earning, which is 20 beginning of the year, 16 end of the year. You make a total of these two retained earnings, and this is 36,000. Plus you will say parents' share in subsidiary. How much is the subsidiary profit? This 1720 multiplied by 75%. Like 1720, 25% you give it to the subsidiary and 75% you give it to the parent. So 1720 and into 75%. So you add it here. So this is done, but then you need to make some adjustment also. If you have adjustment, what you need to do on parents retained earning, that's important calculation. If you remember, there was unrealized profit. That unrealized profit we should be subtracting. So how much is that unrealized profit if you remember?